Welcome to the Ronel Talks Money Show, and today we are going to talk about exchange-traded products, but specifically exchange-traded funds. And today I am very fortunate to have a very special lady and really a powerhouse when it comes to exchange-traded products, Nerina Visser. And I just want to share with you a summarized view so that you just understand she really is a specialist. Nerina Visser is an ETF strategist and advisor with a specialist focus on exchange-traded products and benchmark indices. She's a director of the ETFSA Portfolio Management Company, where she oversees the management of specialist investment portfolios of ETPs for a broad range of clients. She serves as president on the board of the CFA Society South Africa and as chairperson of the ASISA ETF Standing Committee. She's a regular market commentator in the media and a seasoned speaker at conferences, seminars and workshops in South Africa, throughout Africa and on the global stage. Nerina, thank you so much for joining me today and welcome.
Thank you. Morning, Ronel. It's wonderful to be with you and to get this opportunity to really engage with your followers, with your viewers. And I think we both feel equally passionate about financial education, financial literacy. I really believe that the power lies in education. It lies in understanding finances and money and so on. And I think you are doing great work in this space. So very happy to be part of this initiative. Thank you.
Thank you, Nerina. Now, I think let us kick off, and I think there's so many things out there, but what made you decide to become a specialist in exchange-traded products, of all things out there?
Yeah, Ronel, it's actually a story with a bit of a tale to it. I have been in the investment industry for more than 25 years. I was a quantitative analyst, a quantitative strategist. To be honest, when I first started on this journey, I couldn't even pronounce the word quantitative, let alone know what it means. But I've always been a numbers person, somebody who really loves maths, numbers, and so on. And for me, the passion around implementing this in the investment industry and helping people really to reach financial freedom, financial comfort, and so on, brought together two of my biggest passions. In terms of my development and why I ended up specifically focusing on indices and on exchange-traded products, ETFs as we often refer to it, really does stem from the fact that this was a quantitative basis where a lot of this started. So it was about representing the market or different investment opportunities through indices. Now, the concept of an index might for many people seem a little bit foreign, but really an index, if you think about a recipe, if you think about wanting to bake a cake, for example, if you want to bake a cake, you take a recipe and it tells you what are the ingredients that go into that cake and what are the quantities, you know, how many eggs, how many cups of flour, how much sugar or milk. And an index is much the same in that sense. It tells us what constituents or what ingredients we have in that index and how much of each of those constituents or ingredients we need. And so for me, developing into this specialist area in the investment market really came from the premise that I understood what ETFs could do for people in their financial journey. There are lots of benefits that we can go into a bit more, but I think important to understand that I don't believe that this is the only way that one can do investments, but I just felt that there were enough people that were focusing on, let's call it the more traditional way of managing investments. And there were not nearly enough people looking and focusing on the benefits that ETFs, indices, index tracking products can bring to the equation. So for me, it was a very conscious choice to choose the specialist area and say, I will become a specialist in this particular area and use this to help people achieve financial freedom, achieve investment success, complementary to maybe other things that they might already be doing in the investment space. So yeah, it was a very conscious decision. It was a very specific choice. And it really was just because for me, there was a bit of a Damascus moment. I remember when I first sort of got it, when I first understood why ETFs and index tracking products can be so powerful. I just thought, you know what, this is something that I was blessed enough to understand and get, and I will make it my life's passion to share this with other people and introduce them to the benefits that this can bring to them in their investment portfolios. And we'll talk a lot about those benefits during the course of our discussion today. But yeah, that's really a bit of backstory as to why I chose this particular area of the investment market.
Well, Nerina, we are very grateful that you've made that decision, because this is quite complicated. And I think if you just hear the words exchange traded, it already sounds like you want to run away. And you definitely need people like yourself to simplify it and to make it easier for people to understand. And I think even if you think about the abbreviations, ETF, and it can be confused with EFT, and it makes like in all these things. And so it's great that you can help us today. And I want to ask you, first of all, if you can maybe just simplify for us, if you think about exchange traded products, and then the two types in terms of exchange traded funds and exchange traded notes. Just if you have to explain to us in layman's terms, what does it involve or entail?
Sure. So I appreciate that the abbreviation ETF, or even the term exchange traded fund, can seem quite overwhelming for people. But really there are two components to that term that really describes exactly what it is. Let's start with the F bit, the fund bit. Most of the ETFs, as we have them in South Africa, are also registered as collective investment schemes. Now, that's another big word, a CIS, another acronym or abbreviation, but it's really what you and I know as a unit trust. So most investors are quite familiar with the concept of a unit trust, quite comfortable with the idea of a unit trust, and an ETF is also a unit trust. So the fund component means that the vehicle, the product in which the investments are held, is exactly the same as you would find with any of the other 1,700 odd unit trusts that are available in South Africa. It means they are very well regulated. It means they are very well guarded and overseen. It's a very low risk investment from a regulatory perspective. In other words, the FSCA, the Financial Sector Conduct Authority, has got very strict rules around what you can invest in and how it's managed, how they ensure that the assets inside that fund is protected specifically for the investors in the fund. So as much as we are comfortable and familiar with unit trusts as an investment option, an ETF is exactly the same. But the second part of it, the ET part of it, and this is not about ET phone home. I think I'm showing my age by knowing who ET was, but the ET being exchange traded, I think is sometimes something that people sort of shy away from or that they're fearful of. Exchange traded, as the name suggests, really just talks about where do I buy this investment product? Where do I access it? So yes, I hear you, Nerina, it's a CIS, it's a unit trust, it's a fund, it's a very safe fund that I can invest in, but where do I buy it? And it is exchange traded. Now, exchange in the specific context means the Johannesburg Stock Exchange, the JSE. Now, often when you say to people JSE, or you say the exchange, or you say the market, that's another thing that people are fearful of. And they say, oh, no, but it's too scary to invest in equities, or it's too scary to invest in the market. You know, I had sign-off, or I had some property companies and I lost a lot of money. I want us to differentiate between the exchange, the JSE, as a place where one buys the shares of individual companies, of many of the South African companies that we're very familiar with. Absolutely, that is the place where you would buy those individual shares. But I also want us to think in terms of the exchange really as a shopping center or as a grocery store. Let's think about it that way. It's a place where you go to buy investments. And the type of investments that you can buy at the JSE is a lot more than just shares in South African companies. So just like I can go to Pick n Pay and I can think of Pick n Pay as my grocery store where I will buy my food and my vegetables and my bread and milk and meat and so on, I can also, at Pick n Pay, buy clothes. Or at some Pick n Pays, I can even buy my cleaning materials, or maybe pots and pans, or some hi-fi equipment or whatever. So just like that shopping centre, that grocery stores provide you the ability to buy things other than just the groceries, so the JSE, the stock exchange, is exactly the same. So when we are talking about ETFs or ETPs, exchange traded products, I want people to think of the exchange traded bit as the place where I go to buy my investments. And there's quite a broad range of these types of investments that we can buy. So just like in my example of Pick n Pay, where I can buy groceries at Pick n Pay, I can also maybe buy clothes, or I can buy makeup there or whatever. And in fact, I can even buy some imported stuff at Pick n Pay. I can go and buy my favorite Belgian chocolates at Pick n Pay. Yes, I'm shopping at my local Pick n Pay, my South African grocery store, but what I'm buying there is actually beautiful Belgian chocolates. And much the same we can do at the JSE. We can buy ETPs, exchange traded products, exchange traded funds, not just of South African investments, but we can also go and buy global, international investments through the ease and the comfort of our local store, if I can call it that, our local stock exchange. And I think that's a very important differentiation that people need to make, is that buying something on the stock exchange does not mean that you are necessarily buying shares in South African companies only.
So then it's almost correct to say that you can see exchange traded funds almost as a hybrid between unit trust and investing in shares.
Absolutely. That is such a good way to describe it, because it's exactly that. You are buying them and transacting in them just like you would with individual ordinary shares. So where you buy it, how you buy it, the type of account that you need to buy them is exactly like shares. But what you buy is funds. It is not single shares that you are buying. And that starts getting us to one of the big advantages of ETFs, and that is that you've got the diversification, that variety of, with a single transaction, you are buying a group of investments, a basket of investments, not just shares in a single company, but actually a nice mixed basket. So think again of my Pick n Pay example. I'm not just buying bread, I'm actually buying a whole basket of groceries from which I can make a lovely balanced meal. I can have my meat and my veggies and my dairy and my starches and everything. And ETFs and funds are exactly the same. You're buying a nice, diversified, balanced basket of investments through a single transaction.
Oh no, that's already such a big benefit. And I think because exchange traded funds would typically track an index, but maybe you can just explain to us a little bit, what does it really mean in terms of an index? What is an index, the easy way?
So I want to go back to the example that I just sort of alluded to right in the beginning, that I like thinking in terms of an index, much like I would a recipe, where the recipe is really sort of telling me how much of what should I have in my cake or in my food that I'm making, much the same in terms of investments. So index tracking is a term that is used to really demonstrate how the fund manager would decide what investments to put inside this unit trust, this fund that underpins the ETF. So let's take an example. One of certainly the oldest ETF that we have, and one of the best known ones, tracks the top 40 index on the JSE. Now, the top 40 index is the 40 largest companies that are listed on the JSE. There's 40 of them, so we know the number. We know the list of those 40 companies. The JSE publishes that on a regular basis, so they will tell you exactly which are the 40 companies that make up the index at any point in time. And then very importantly also the weights or the quantities. How many of each of those companies, how many shares of those do I need to buy to represent, to track, to reflect, to replicate the index? So if the index says that there are 200 Naspers shares in every basket of the top 40 index, then the fund manager will go and buy 200 Naspers shares in the fund. And they might say that there are 50 Standard Bank shares in each top 40 basket. he will buy 50 Standard Bank shares in the fund, and so it goes on. So one of the beauties in terms of such an index tracking process is that the index changes over time. So the JSE has got an index committee that once a quarter, every 3 months they meet, and they assess and they say, well, at the moment, which are currently the 40 largest companies on the JSE? And that basket changes over time. As new companies come onto the market, or as companies are maybe taken over, or they sold off, or they delisted, or they unbundle, all these sort of fancy things that companies can do, that index reflects the current status of companies on the JSE. And it will always, therefore, reflect the 40 largest companies on the JSE. And so as an investor in such an index tracking product, you remain invested in the same single investment fund, this top 40 ETF, for example, but the makeup, what sits inside that fund, changes over time. And you as the investor, therefore, are not required to keep up with what's changing and what new companies are being listed, or what is changing in terms of companies delisting or falling out of the index. That's done inside the index, and therefore inside the fund for you as well. And that's why it is actually a very good way to remain invested and always be invested in, this example, the 40 largest companies on the JSE. You don't need to know who they are. You don't need to know what they are, whether they're performing well or badly or whatever. It is just the 40 largest companies on the JSE, which, by the way, is more than 85% of the JSE, the market cap, so the size of the JSE. It's only 40 companies, but it makes up more than 85% of it. So with a single investment in such an index tracking product, you basically get exposure to more than 85% of what's available on the JSE in terms of listed South African companies. Now, the top 40 index that I use now is just one example of such an index. There are many, many more. There are thousands of indices available, not just in South Africa, but around the world. And you can have such an index tracking strategy or an ETF that tracks any number of these different indices. So I use the example now of the top 40 index, but one could do exactly the same, for example, with the FINI 15, the Financial 15 index, that invests in the 15 largest financial companies that are listed on the JSE. Or you could be invested in the S&P 500 index. That happens to be the 500 largest companies that are listed on the New York Stock Exchange. Or the FTSE 100, the 100 largest companies on the London Stock Exchange. Or the MSCI World Index, the 1,700 odd largest companies in the world in developed markets. So you can see that just like with cake recipes, there would be a difference in your recipe between a chocolate cake and a carrot cake and a red velvet cake. Just like you have different recipes for different types of cakes, you have different indices for different types of index tracking products, ETFs. And I often find that that makes it easier for people to understand what is this concept of an index when you think of it as a recipe, really, in terms of just guiding you what you will be invested in terms of your ETF.
Nerina, I think like if I listen to you, I definitely can hear there's been a lot of a typical unit trust, the benefits of investing in a unit trust. That's also been like in when you are investing in an exchange traded fund, which is definitely, you know, like in bringing in all of those benefits, but then you obviously also have now the index tracking and all of those, which are also your additional benefits. But you have mentioned now a couple of the advantages already, but maybe you can just deal a little bit more with what are the pros and the cons investing in an exchange traded fund.
Yeah. To be very honest with you, I find it quite difficult to find many cons or many disadvantages of investing in exchange traded funds. That doesn't mean to say that there's not people that will very actively try and dissuade you or trying to convince you that this is not a good investment strategy. So let's maybe address some of those more popular notions that are presented against index tracking investment. This is often also referred to colloquially or in the market as passive investment. And passive is really a very unfortunate term in terms of it, because passive sort of evokes these emotions with us of, oh, I'm not doing anything, nobody's doing anything, everybody is just sitting there and not doing anything, and that can't be a good strategy. Surely you've got to engage with your investments and you've got to think about it and so on. But passive really just means that it's that index tracking, in other words, replicating that recipe, that index. Passive does not mean that there's no investment decision being made. Your choice of which index to track, which ETF to invest in, remains a very active decision. Going back to my example of the cakes, to choose whether I'm going to go for a carrot cake or a chocolate cake is an active choice. How those two cakes are baked and put together might be quite passive in the sense of they're just following the recipe. But my choice of which cake, my choice of which index and which ETF is a very active one. And that's the level at which the decision making for the investor should be made. So the criticism that we often hear about index tracking products also is that they are, you are guaranteed to be below average, because the index is supposed to just reflect what the average performance of the market is. And because an ETF, just like a unit trust or any other investment fund, has some actual physical, real costs involved in managing it, whereas the index is just a mathematical calculation with no costs in it, your real fund, your actual fund that tracks that index, will necessarily give you slightly less performance than this mathematical calculation, this index. So there's this notion that, oh, by investing in an index tracking product, I am necessarily going to be below average. And nobody likes the idea of being below average. We all want to be above average. So in this hunt or this chase for being the best or being above average, I think the interpretation of many people is that this mathematical fact that an index tracking product is going to give you returns that are slightly less than the index itself is interpreted as the evidence of being below average. The reality is that that index itself is a reflection of the average performance in the market, but it is not a reflection of the average performance of the investment opportunities in the market. What do I mean when I say that? So we're familiar maybe with the unit trust industry, and so I can go and I can select from any number of, as I mentioned, I think it's in excess of 1,700 unit trusts nowadays that one can choose from. And so when you look at the performance of all of those unit trusts, and let's even look at that in a particular category such as South African general equity, so just unit trusts that invest in the South African listed companies. When I look at the average returns of those funds, it's quite different than the average return of the index. And in fact, there's a lot of studies that have proven, not just in South Africa, but around the world, that the average performance of such unit trusts that invest in a particular market at around 80 to 90 is significantly below the index. So therefore, being in an index tracking fund, you might be below the average of the index, but you're well above the average of all the other funds that are available in the market. And I think it's an important difference in terms of understanding what does average actually mean. And one of the main reasons for that underperformance of actively managed funds in the unit trust that we have does sit with investment costs. Because ultimately, we're all investing in the same market. And therefore, the average return across all of these funds should be reflective of the average performance that's available in the market. But your costs take away from your return. So the bigger the costs, the bigger the level of underperformance. The less the costs, the smaller the level of underperformance. And that brings us to one of the other major benefits of index tracking funds or exchange traded funds, ETFs. And that's that they've got very low costs compared to actively managed funds. And so it gives you that extra buffer, that extra margin of safety that you are actually just below the index rather than potentially significantly below the index, which is where we find many of our actively managed funds to perform.
Okay, now that's really awesome to know kind of like how many benefits there really are, and that there's not really a big kind of disadvantage of following this route.
Yeah.
But but Nerina, would you say that it is more of a longer term investment, or is there reason to believe that it can work as a shorter term investment as well?
So I think it's very important that we consider investments, whether we buy them through a vehicle such as a unit trust or a vehicle such as an ETF. You're really buying the same type of underlying investment. And so the time horizon that we consider when we look at investments has got everything to do with what's in that underlying investment fund, and it's got nothing to do with the vehicle through which we buy. So this is not about a comparison between unit trusts and ETFs. It's rather about what is the underlying investments. So let's take an underlying investment such as inflation-linked bonds as an example, because that's probably one of the lowest risk type of underlying investments that one can get. That type of underlying investments can be, if you wanted it to be, a relatively short-term investment because of the low risk, the low volatility that is associated with it. And let's contrast that maybe to an investment in physical gold, which can be highly variable and very, very volatile, and where the intention should certainly be much more focused on a long-term investment horizon to allow time to really sort of cope with that volatility or that variability. So I would like people not to think in terms of, are ETFs good short or long-term investments, or are unit trusts good short or long-term investments, but rather to say, well, what type of unit trust is it that I'm investing in? Am I investing in a money market unit trust, for example? A money market unit trust is the lowest risk that you can get. So you can do that for a very short term, and you know that your capital will be protected. Similarly, you can invest in a money market ETF. The same thing, it's going to be a very low risk. Or you can be invested in a very high risk unit trust or a very high risk ETF. So we always need to understand what is inside the fund, what is under the hood, what is inside my investment fund. And that will determine the level of risk that we are taking on, and therefore also tie that back to our time horizon in terms of for how long should we intend to at least hold this investment before we start thinking in terms of drawing on some of that investment funds.
But Nerina, now that you say there's literally you can go from like a low risk to a high risk, what are typically the risks involved, and what can you do to mitigate those risks?
So the risks are virtually 100% related to the underlying investment. So it is how risky is the underlying investment, what is inside that fund. As I mentioned, it's got very low regulatory risk. It's a very safe investment from the perspective of nobody's going to take your money and run away with it. But it can be high risk if the underlying investments is quite high risk. So exactly in the same way that one would assess the risk or the investment strategy around investing in unit trusts, you will apply exactly the same principles to deciding what is the best investment strategy for the types of ETFs that I will choose in terms of my investment strategy. And I think the advantage that we know, certainly in terms of managing risk, usually sits in diversification. You want to mitigate the risk as much as possible by being invested in many different types of investments. So each ETF on its own, just like each unit trust on its own, is already diversified to some extent. So already we are not just investing in a single company or a single asset, we're investing in a basket of one. So that's a good first step in terms of mitigating the risk. The next aspect would then be to say, but let's maybe also not invest in a single unit trust or in a single ETF. Let's invest in a couple of different ETFs that give us exposure to different types of markets. So let me invest in some South African equity ETFs and some global equity ETFs, and not just developed market equity ETFs, but also some emerging market ETFs, for example. Let us step beyond just equity, so not just shares. Let's also invest in bonds or in property or in commodities. So you can hear now I'm starting to talk about asset class diversification, the classic sort of balanced fund argument or multi-asset fund that we would talk about. And because your ETFs cover the full spectrum, the full range of geographic exposure as well as asset class exposure, one can really put together a very, very well diversified investment portfolio consisting just of ETFs that give you exposure to many different asset classes and to many different geographic regions in the country. And that's the level where I think the active investment decision making is so important. To understand, given my investment objectives and needs, or given the investment objectives and needs of my clients that I serve, is to say, what do they need in their investment portfolio? And then you match those needs with types of ETFs that actually match that. Whether that matching or that need is to generate income or to have high capital growth, or to give me some exposure to offshore investments to mitigate against rand depreciation, or whatever the need might be that you have in your portfolio. You start with your objectives and your needs, you match it to how can I actually get that protection or that exposure into my portfolio, actively select those different ETFs. And those are one of the best ways to mitigate the risk. That you've got not just the diversification in your portfolio, but that the risks that you've taken on in the portfolio matches your investment objectives, your needs, because then risk becomes a matching between all of my assets and my liabilities, my investments and the investment objectives and needs that I have.
Absolutely, and I think it again boils back to education as well. Even though you have a fund manager involved, even though you have maybe an advisor, the more knowledge you as the investor have, obviously the better your things will perform, because you can at any point still look at the performance and see, okay, but my situation has changed, something has changed, so I want to, change my portfolio. So I always say that there's no way that you cannot have a good, solid understanding and education of any investment type, and then only you can really expect kind of maximum performance and results, and also what is important to you as an investor.
Yes, absolutely. And I like to, at this point, I would like to bring in maybe a third aspect about ETFs that I think really brings a lot of benefit to the investor, and it is their transparency. So ETFs, unlike unit trusts, have to disclose every single day exactly what they hold in that ETF. So if I'm an investor in a unit trust, I don't really know what's inside it. I can look at the fact sheet of that unit trust as it was maybe at the end of the previous quarter or at the end of the previous month. So I know what was in that investment in the past. But where I stand today, when I buy that unit trust today, I actually don't know what I'm buying. Whereas with the ETF, there's full transparency. I can go and check on the ETF issuer's website every single day and say, what sits inside my ETF? What am I actually investing in? So ETFs really lend themselves exactly to this space of financial education, of engaging with your investments, understanding what you're invested in, understanding what type of performance I can expect from my investment, because I know what my underlying investments are. And I want to go back to the Steinhoff example, because I think it was very pertinent at the time. When the Steinhoff, bomb burst in our market, there was a mad scramble for people trying to know whether they actually were invested in Steinhoff or not. So I'm not talking about people who had stockbroking portfolios where you knew, but if you were invested in unit trusts, people didn't actually know whether they had exposure to Steinhoff or not. In fact, the Financial Sector Conduct Authority had to send out a communication to all unit trust fund managers and say, please report to us and tell us whether you have sign-off in your portfolio or not, because nobody knew who had what sign-off exposures. In the case of the ETFs, it took me less than 5 minutes, and I could tell you exactly how much sign-off exposure there was in every single ETF in our market because of that transparency. And as we are moving forward in terms of almost a generation of informed investors, investors who want to know what's happening with my money, where is it being invested, what is my money doing in the real economy, and so on. That transparency, I think, is absolutely vital, because the younger investors of today really want to know what's happening with their money. And I applaud them for it, because I think it's an engagement with your money, your own hard-earned blood, sweat, and tears. You want to know, and you should know, what's happening to my investments. And so I really encourage people to do exactly what you're saying. Educate yourself, go and look, find out, learn more. The internet is a wonderful place in terms of access to information. And that ETF transparency then just brings you that extra layer of transparency to say, well, I can see exactly what I'm invested in. And am I happy with it, or am I not happy with it? And then you can change based on your sort of proper assessment. And proper assessment, as far as I'm concerned, has got very little to do with past performance. We make a huge mistake when we look at our investment decisions, where we judge and we make so many of our investment decisions on the basis of past performance. And it's one of the worst bases on which you can make an investment decision. I often say to people, that is the equivalent of driving your car by looking in the rearview mirror, rather than looking through the windscreen in terms of what is in front of me in the road. And trust me, if you drive by looking in your rearview mirror, you will make an accident somewhere along the line. So think the same way about your investments. By looking at past performance, the only thing that I can see from that is, what performance did somebody who has been invested in this fund achieve in the past? It tells me nothing about what performance I will get from investing in that today going forward. So you might then say, but well, then how am I supposed to know what performance I can get from our investments? And that's where we start looking, maybe when you look at your ETF, or even if you're a unit trust, and you say, what companies I'm invested in? Oh, I see I'm actually invested in a lot of mining companies. Let's see, what's happening in the mining industry globally? Are commodity prices increasing? Are there problems with labor on the mines? Oh, I see I'm invested in a lot of banks. What is the outlook for banks in South Africa? Are they reporting, that they've got lots of debt, or they've got problems in terms of growing their book and extending credit, these sort of things. So now we start engaging differently with our investments. We try and understand better what will drive the performance of those investments in future, because the past performance is exactly just that. It is just in the past, and by investing in that today, it doesn't tell me anything about what I will get from my investments in the coming days.
No, I absolutely love that, because I think, like, with transparency, I think that is absolutely where the future is heading to. And that's, again, like, the more you know about what's going on in your investment portfolios, and you have access to that information, the better decisions you can make. But I want to touch on if somebody is interested now in investing in ETFs, how can you start off, and is there a minimum investment requirement?
Okay, as I mentioned, because an ETF, that ET but exchange traded, means that you will necessarily be buying a fund which is listed on the stock exchange. It means that the only way that one can buy this is through some account that actually allows you to buy investments on the stock exchange. And so there are three ways in which that can be done. The first one is directly with a stockbroking portfolio. So that could be an online stockbroking portfolio. It could be through a traditional stockbroker that you might be dealing with. So if you have an online share trading account or a stockbroking portfolio in which you buy the shares of individual companies, in exactly that same account, you can buy those ETFs. They have got a share code, just like the individual companies have got share codes. And so in that account, you can buy those very easily. It's a very straightforward process. The second way that one could do that is some of our LISP platforms, linked investment service provider platforms. So those are the platforms through most people buy unit trust investments and maybe even investments such as retirement annuity funds or those sort of things. Some of the list platforms do also offer access to ETFs via their list platforms, but not all of them do, and not all of them offer access to all of the ETFs that are available. So unfortunately, that's an aspect in our market that still needs a lot of development. But if that is where you are currently investing and you can't get that there, ask those questions from your list, ask those questions from your financial advisor, and ask them, if it's not available, why not? Why do I not have access to it? And in that way, we can hopefully open up more of the market to a broader range of investments. But the third option then would be to invest via a dedicated platform that focuses specifically on ETF investments. And that's exactly what etfSA, my company, does. So etfSA, exactly as the name says, Exchange Traded Funds South Africa. And by the etfSA platform, one can invest in all 89 exchange traded products that are available on the JSE. And one can do so either in a tax-free investment account, for example, or you can do so in an ordinary investment, a discretionary investment portfolio. Or one could even do this for a retirement annuity or even living annuities or whatever. So there is two things that one's got to consider here. Where do I buy these investments? But very importantly also, what type of account do I buy my investments in? And for many people, if this is the first type of investment in ETFs that you're going to be making, I recommend a tax-free investment portfolio. Tax-free investments really is, for me, the no-brainer. The first 36,000 Rand that every single South African has available to invest every tax year should go into a tax-free investment portfolio, irrespective of your age, irrespective of how much tax you're paying or not paying or whatever. It is an allowance that government gives us that says those same investments that you can do in your ordinary unit trust portfolio or your ordinary investment account, you can do those same investments in a tax-free investment account, and then you don't pay tax on dividends, you don't pay tax on capital gains, you don't pay tax on interest and so on. And I think we all love the idea of not paying tax. So the first step would be to make sure that you have a tax-free investment account, different than a tax-free savings account. Let me just quickly maybe focus on that. It falls under the same legislation, and in principle, it's the same thing. But for me, the difference lies in, again, what do I put inside that tax-free account? And many people have tax-free savings accounts, and the only thing that they hold in those are just ordinary savings accounts at banks. So something that you can only earn interest on. And as we know nowadays, that's not a lot of interest even that you can earn on it. The problem with that is that you are using your tax-free allowance, that 36,000 Rand a year that you have every year, but you're using it to invest in something that can only give you interest, and therefore you only save tax on interest. Whereas if you use that same 36,000 Rand to invest, to buy ETFs that pay dividends, that have the potential for capital gains and so on, your potential to save tax is a lot more. So I always recommend to people, if you don't have one yet, make sure you open a tax-free investment account. If you have a current tax-free savings account, you can transfer that to a tax-free investment account and therefore change the underlying investments from just bank savings to ETF investments that therefore give you much more potential in terms of that. So for me, that's the starting point. Think of this as a long-term investment. Think of this as part of your retirement savings. The fact that you're allowed to access your tax-free investments shouldn't tempt you to draw from that in the early days. Think of it as the longest possible term investment, because one want to have massive capital growth on that and not have to pay any tax on that investment. So starting out with ETF investments in such a tax-free investment account is also a great way to start learning more about these things. How do they perform? What do they do? What exposure do I get? Buy an ETF and then say, well, what is actually inside this thing and how does it perform under different market conditions and so on? Use it as an opportunity to learn, because ultimately I think that is one of the best investments that we can make, is this investment in our financial education, in our investment education. And I think ETFs inside a tax-free investment account is one of the best platforms, if I can put it that way, to actually allow you to do exactly that type of learning.
That's great, Nerina. I always like these tax-free options that's available, and I always encourage people to definitely include that in their portfolio, because if that is available, why wouldn't you be using it? But exactly. I also want to just, you have touched now also on this capital growth. There's also like your more income generating, but maybe you can also just explain to us what are the typical returns that investors can expect.
So the returns that you can expect from your ETF investments is exactly the same returns that you will get from the underlying investments. And it is very similar to the returns that you can expect from unit trusts in that same category. So because ETFs come in so many different shapes and sizes, in terms of the underlying investments, there's no such thing as comparing all ETFs with one another and saying, ETFs give good returns or ETFs give poor returns. It depends on what the underlying investment is. So when you look at the performance of those ETFs, it is reflective of the market in which they are invested, exactly like the unit trust as well. So if you are invested in an ETF that gives you exposure to interest-bearing investments, I mentioned, for example, a money market ETF, or even government bond ETFs or whatever. Then in the money market one, for example, well, you could probably expect that you're going to get in the region of about 4, maybe 5% per annum if you're lucky. Not much more, not much less. So that because the money market returns are fairly well known, we know what we can expect from that. When it comes to something like government bonds, the bulk of your return that you're going to get from that comes from interest. The coupons, the interest payments that are paid out of those government bonds twice a year. And at the moment, that is sitting in the region of about 9% per annum interest income. What is the second part of our total return equation? We've got income, which can either be interest or dividends or whatever. But then the second part of that equation is capital growth or capital loss. So do those bonds trade at a higher or a lower price over a period of time? So the 9% interest return is a given, but we don't know what the capital component will be. That can be positive, that can be negative, and the total return that you will get will therefore be that 9% plus or minus whatever happened on the capital side. But because the 9% is quite chunky, it gives you a reasonably good idea of the sort of return that you can expect from a bond ETF. Fast forward that then to an equity ETF of something that is paying no dividends because it is in maybe a high technology type of exposure or whatever. Now my total return consists of nothing or very little dividends and massive potential for capital gains or losses. So what returns can I expect from that type of portfolio? Well, it can be very good or it can be really bad. I don't know. It depends on the price performance of those underlyings. So I think a very good example of that at the moment is, for example, to look at some of our global technology ETF investments, things like the Satrix NASDAQ ETF or the Signia Fourth Industrial Revolution ETF, for example. Those don't really pay much dividends at all. And they've had massively good capital gains in the last 6, 12, 18 months, for example. But those performance, those capital gains, there's no guarantee that that will continue to perform. It depends on what's going to happen to the technology sector globally and what's going to happen to the rand dollar. Because those all invest in offshore markets, if the rand dollar depreciates, it means the rand value of that investment is going to go up. It's going to go up by as much as the rand dollar depreciates. If the rand dollar appreciates, then the value of that investment is going to fall in rand terms. So you can hear that the drivers, the things that make up the return you can expect to get from an ETF depends 100% on what the underlying investment is, and then think in terms of the makeup of that total return between income and capital gains or capital losses. I'm not giving you an answer because I don't know what returns will be in future. But what I'm saying to you here is that's how you can think in terms of where is return going to come from in future.
Okay, and then just you've touched now on the global exposure, and I think a lot of us all, start thinking more about how do we get global exposure. Now, this certainly is a much safer, if I can call it that, option to go through this type of investment than go directly with some kind of global investment. Would you agree with that?
Absolutely, absolutely. And I want to go back to one of the first examples that I use of buying my Belgian chocolate at Pick n Pay. Contrast that to having to get on an airplane, fly to Belgium and go and buy my Belgian chocolate there. It's a great experience, but it's quite expensive, and that's quite a process to go through to physically get there and go and do your Belgian chocolate investment there. And similarly with our global investments also. Yes, one can certainly take money physically offshore and invest there, but it comes at much higher costs, and you are now operating in a market that you are not that familiar with. Whereas if you do this from the local market, my local Pick n Pay, my local JSE, but the investment that I'm buying is that offshore investment. For me, that really is the best of both worlds, because I'm getting that full exposure to the global investment, but I'm getting it from the safety and the comfort of my very familiar and well-known local investment market through which I buy my investments. So I absolutely recommend that for people, certainly as your first global investments. That's the way that you should be doing it.
Okay, that's absolutely awesome to know. And I think if we come to the last question that I want to ask, we've touched on so many different things, but you've also mentioned to us that it is a lower cost investment type. But what are the costs and the fees that's typically involved?
Yeah. So some of the ETFs on the JSE are come at a total expense ratio of as little as 0.1%. Now, compare that, for example, to your typical actively managed unit trust that typically has got total expense ratios of between 1.5% and 2.5%. So you can hear this is like 15, 20 times cheaper in terms of total expense ratio. The majority of ETFs are available at less than 0.5%, 0.5% total expense ratio. So the TER, the total expense ratio, is significantly lower than that of actively managed unit trust. The other cost you do need to take into consideration is the cost of actually buying that ETF. So your stockbroker cost, the brokerage that you would have to pay, the transaction cost that you have to pay. And that depends very much on the platform or the account through which you buy it. So it's important to do your homework in terms of that and understand what am I actually paying for acquisition, for buying those those ETFs in my particular account, because those costs can vary quite substantially. So think of your product cost, the total expense ratio, which is a lot lower. Your acquisition costs, which is you can choose which platform or where you want to go, and we know that that is, in other words, negotiable almost to some extent. And then there is the aspect of potentially an advisor fee. There's certainly one can do a lot of investments in ETFs without the use of an advisor. But if people feel uncomfortable making these investment decisions themselves, they make sure that you're at least working with an advisor who understands ETFs, who knows what they are and what role they can play in your overall investment portfolio. Those are the three types of costs one needs to consider, and that's really how you need to sort of look at it. But don't be scared of learning more about this yourself and becoming almost your own financial advisor to some extent with this portion of your overall investment portfolio.
Nerina, I absolutely agree with that. I always say to people, even if you don't feel comfortable doing all of these decisions maybe and taking all of these actions, you should still have the knowledge to really look after your investments and at least ask the right questions, because nobody will ever take better care of your financial well-being than yourself. And that is why it is so important that you educate yourself. And I really want to thank you for spending some time with us today. I think you've really made a very complicated topic so much simpler. And I love how you've explained it with the supermarket example with baking cakes. And thank you for joining us today on the Ronel Talks Money Show, and I'm looking forward to spending some more time with you on the next show.